My name is Ryan Goepel. I'm the CFO of Global Crossing Airlines. We are currently trading on the OTC under JETMF and TSX under JET. I was going to go in and tell you a bit about our story. First thing you need to cover, obviously, is the disclosure language. Hold on, just get that slide. The disclaimer language with regards to forward-looking information. So please review that as we discuss the different parts of the presentation. What I wanted to cover here today is really the original investment thesis as to why we decided to start Global Crossing, a discussion of the leadership team, the impact of COVID, the current status, and really why we think now is an important time to consider investing. When Global Crossing was conceptualized by our founder and CEO, Ed Weigel, this was well before COVID in 2019, in surveying the ACMI business. And ACMI, for those who aren't familiar with the charter business, stands for Aircraft Crew Maintenance and Insurance. It's the basis on which we charter our airplanes. Taking a look at the narrow-body charter market, there are very limited options. The options that were available to customers tended to be older aircraft. And we, looking at the market and the business, saw that the lease rates for existing aircraft was getting relatively frothy. We anticipated a downturn and a drop in the rates for older aircraft with the launch of the newer offerings from Airbus and the eventual onboarding of MAX aircraft. And so in order to prepare for what we saw as a really good opportunity in the charter market for narrow-body aircraft, Ed put together an experienced core team to get certified, deliver high-quality product with modern aircraft at competitive pricing. So when you think through what it takes in order to launch an airline, there's really 4 barriers to entry. The first one is getting certified, and that's a process that you go through with the FAA. And really you address that by putting together a high-quality team. The second is the availability of airplanes. The third is the availability of crew. And fourth is obviously the availability of capital to do all the above. So taking a look at what we saw as our options, the first hurdle we went to tackle was the team. So in looking at the team, Ed Weigel, our chairman and CEO, he's been doing this for over 30 years. He helped co-found Atlantic Coast Airlines, which became United Express. He was a founder of Republic Airways, which I believe has over 500 planes active today. He was the CEO and director of BWIA International Airways, and was the founder and CEO of the third iteration of Eastern Airlines, which was launched in 2015. Myself, CFO, I've spent some time the last 2 years prior to this working with ULCC up in Canada. Prior to that, I had worked in multiple industries, mainly oil and gas, and was involved in the Burger King IPO back in 2006. Mark Salvador, our CMO, has over 17 years of travel experience with extensive experience in the cruise ships and gaming industry. He brings a unique perspective, and it really has the perspective of the customer that we're trying to reach, and we're really excited to have him on board. If you look at through the 119 team, so this is the team that's really responsible for getting us certified. Juan Nunez, Chief Operating Officer, has extensive experience, over 6,000 hours of pilot and command, over 12,000 hours in total. He's pretty much flown everything everywhere. Julio Bernard, Director of Maintenance, has been doing this for 25 years, is incredibly experienced in the area. Mike Hambrick, our VP and Director of Safety, has been in aviation for over 55 years. He started flying helicopters in the late 60s, went on to fly everything in the military, and then he went on to be an American Airlines captain, and finished his career working in the FAA. Was the principal or associated with the Eastern Airlines as an FAA representative. Once he decided to retire, found out Ed was launching this operation, he decided to come on board. So with this team, along with Julio Abreu, Whitey Darmus, and Hector Crocker, we felt we had a great team to go get the manuals done, to get the certification done. And we effectively launched at the end of last year, of 2019, with the process of getting certified. Then COVID hit. I think not everyone anticipated COVID hitting, but it did have a significant impact on the aviation industry, as has been well documented. I think from our perspective, it sort of changed the scale of our opportunity. And when you go back to the beginning, when we talk about the 4 largest hurdles, what it did is the biggest impact was on airplanes and crews. So we basically saw a significant or weakened or eliminated competition, a dramatic increase in a pool of available pilots, flight attendants, operational staff up and down the organization, and a dramatic increase in the number of aircraft that were available and significant reductions in the lease rates, which we believe has created the opportunity that we're taking advantage of today. So when you think about where our current status is, this really kind of lays out the certification process. We are currently in phase 3, which is referred to as the design assessment phase. Once this is completed, you go into performance assessment, which is effectively you implement the system and then you demonstrate you can perform the processes and procedures put in place. And then eventually the 5th phase is the administrative functions, which results in the certification of the company. We anticipate late Q1, so not too far away, our ability to get certified, and once certified, we will be in revenue service. And once certified, one of the things I want to talk about is kind of our plans going forward, and also the delivery schedule for the first 10 aircraft. The aircraft you saw on the first cover sheet, and something we announced today, was delivered in December. It was painted and delivered to Miami, which is our home base, on Sunday, MSN 2695. Our second aircraft, which is an Airbus A321, will be delivered in March, followed by a subsequent number of aircraft that we're looking to take delivery of over the next 6 to 12 months. One of the things that should be noted, and one of the opportunities that has been created by COVID, is the actual lease rates that we're paying. I think one of the things you should consider is when we are looking to lease aircraft in the January-February timeframe, we are looking at aircraft that were requiring something around between $180,000 and $200,000 a month, plus a 6-month deposit, which would require about $1.8, $2 million worth of capital to really bring on board and get certified. Eventually, the byproduct of COVID, with significant amount of airplanes on the market, we've seen lease rates for these aircraft drop significantly. The terms have improved dramatically for carriers like ourselves, and we're able to, for example, in the first couple aircraft, contract on a per hour basis, which means if we don't fly, we don't pay for the aircraft, and allows us which is once a pretty high risk fixed cost, turning into a low risk variable cost through the initial ramp up of operations. We have also seen significant discounts from vendors as they anticipate where we think we can take this airline. We're one of the few companies launching an airline at this time, and so we're able to take advantage of that. As a result of all of these kind of impacts of COVID, we initially budgeted around $10 million to get certified, and we're probably going to come in around half of that. Now, once we are operating, we believe we're going to have a cost structure in place that makes us quite competitive, and we are forecasting an operating income per plane of around $150,000 per month. And so as you look at where we're looking to develop the airline, where we're looking to grow it to in the next 12 to 18 months, I think as I get into later, why now, you sort of see why we think we're a pretty attractive opportunity at the time. So what does this really translate into? So getting planes at lower cost, and when I go back to what we're doing, which is providing charter services to hotels, casinos, sports teams, tour operators, local governments, airlines, you look at your cost structure, and really when you go look at the ACMI, the insurance is effectively around the same, whether it's pre-COVID or post. The crew costs are effectively the same, pre or post. The big difference is they're available, and we've been pretty excited about the quality of people we've been able to bring on board. The maintenance tend to be the same, and the only real differentiator on maintenance is your ability. The newer the aircraft, the lower the maintenance cost. So when we compare ourselves to who we're flying against competitive-wise, our aircraft tend to be a lot younger. They tend to require less maintenance. And finally, the biggest difference is the aircraft, the actual lease rate. And so our ability to get leases at significant discounts along with newer aircraft, we think we will be able to offer pricing, or our cost structure will be about 40% lower than the competition. And on top of that, by not effectively operating aircraft during COVID, we haven't had to incur significant debt or costs that have to be recouped at some point in the future. So when you think about what we're trying to do as a company is launch as a chartered airline in the late Q1 with a clean balance sheet, newer planes, and one of the lowest cost structures in the industry. So how does that translate into when you think about potential revenue going forward? As we said, we've been pretty aggressive in working on how to fill our first two planes. We feel our first two planes are effectively sold. We're fairly confident in our ability to place additional planes with various customers. One of the benefits of what we're trying to do in becoming a flag carrier, a US 121 flag carrier, is it gives us a platform on which to not only chase multiple revenue streams, but also multiple products. So in our planning going forward, we're initially going to start as a passenger charter. We're also going to add cargo with the A321F. We believe the A321F is a differentiated product and will be in high demand. We think it's a natural replacement for the aging 757 fleet, of which there's about 346 currently operating in the United States. So we think going forward, our revenue stream will be approximately half passenger, half cargo once we get to full size. And we're anticipating, a fleet of 15 cargo at minimum. We currently have an LOI for 10 to be delivered and slots to convert another 5. And so when you look at our revenue stream, it's not concentrated in any one area. It's a combination of flying with tour operators, as I said, airlines with the South America, major hotel and casino groups, and cargo as well. So one of the things, like I said, as we're trying to put together is a pretty strong pipeline, a diversified revenue stream, and aircraft that are effectively at pretty low cost. Speaking of aircraft, this is our first A321. It is currently finishing up a maintenance check. It's in our new colors, our new livery. We will take delivery of this in the United States in March. It's going through the registration process, and that will be going to work pretty much the day it lands and we get certified. The first A320 and this is a photo of the inauguration, our CEO presenting at a ceremony that was held at Miami Airport, arrived in Miami on January 17th. We're pretty excited. This will be our certification aircraft. This is the aircraft we'll use to do the performance part, the phase 4, as I discussed earlier, and is effectively a fantastic plane that we think is going to be in high demand compared to some of the other options that are out there. And speaking of sales, and one of the things that's driving it is we've started, and this is kind of a sneak peek for people who've been following us, we're revamping our social media, putting out some of our marketing and advertising campaigns with trademark phrases such as our birds of play, you can't beat the experience. And I think for those who have followed us over the past year, have been clamoring for some of the marketing and some of the promotional stuff, you're going to start seeing that rolling out in the very near future. So finally, where we want to get to is why now. So if you think about why is this an attractive opportunity, why is this a differentiated opportunity? One of the opportunities that's been created as a result of COVID is really the access to planes at a relatively extremely low cost. And there's two ways to really monetize that. You can buy them and hope to lease them out, or you can lease them or buy them and operate them at a profit. And we think what GlobalX provides is a fantastic platform by which to acquire some of the well over 300 to 400 A320s we see being available in the market today, and putting them to work in a way that's profitable and sees a pretty significant growth. So in the end, what GlobalX is going to become a U.S. flag 121 carrier, certified to operate in the United States and in various places around the world. We're looking to build our fleet up quickly to 10 planes and then eventually grow it to 30 to 40 planes. And if you were to back into the profit number as it relates to per plane per month, when you do the math on that math, you'll find that our market cap currently represents a really good opportunity, because I think when you look at our price per share, it doesn't reflect that people necessarily believe we're going to get certified or that we can do this. I think our team is incredibly confident we're going to do it. We're seeing the work coming together, and we think there's a pretty big runway going forward for us. So that's pretty much what we had to cover. I know that's pretty quick, but I thought I'd leave lots of time for questions if needed.
Great. Thank you, Ryan. I appreciate this. This is Poe Fratt from Noble Capital Markets. I cover the transportation industry here. And I'd like to highlight that if we do have questions from the field or from the viewership, there's a bubble in your lower right screen that you can click on and then submit a question. And Ryan, there is one question that came in that maybe we can address right away. Is you mentioned phase 3 and phase 4, they will be finished at the end of roughly the end of March, and you'll be fully certified at that point. Will they run concurrently, or will you have to finish 3 before 4 starts, or can you just give us the timing of what's remaining to be done with the FAA?
Yeah, so we're in daily conversations with the FAA. They're effectively reviewing our manuals. There's some 32 manuals that need to be approved. And so your manuals do need to be approved before you can do phase 4. But the aspect of what is concurrent is we had our training programs approved in late December, which allowed us to hire our first class of pilots and our first class of flight attendants. And they're currently going through training. So an aspect of you need trained pilots and flight attendants in order to do phase 4. So that's probably the concurrent aspect of what's going on. The way it works is we're effectively in daily conversations with the FAA about the manuals and changes and the status of where they are. Once they're accepted, we go into something called tabletops, which is basically a dry run. You run scenarios where we demonstrate the operational team is capable of following the manuals, responding to questions, and performing as expected by the FAA. And then once that's done, we go into what's called proving runs, where we actually fly the plane between 70 and 100 hours, running kind of the same scenarios. And so I think from that perspective, it's sequential, but there is a lot of overlap. So to prepare for phase 4, there's a lot of things you got to do now, which we have put in place. We have put our software in place. We put our maintenance systems in place. We put our operation systems in place. We have our pilots and flight attendants in place, and we have our plane, which is a big part of flying, right? So from that aspect, we believe that phase 3 is generally one of the longest phases, and we feel we're pretty confident we'll have that wrapped up, and then we can move right into phase 4 and 5.
Okay, great, thanks. And then if we can sort of talk about the market that you're targeting, as you mentioned, it's twofold. It's cargo and also the charter and tour market. Can you give us an idea of how those markets have been impacted by COVID-19 and sort of the outlook as you bring planes on to the onto the market?
Yeah, so I'll talk about the passenger first, right? So one of the obviously passenger traffic is way down. I think U.S. traffic is around 55-60% of where it was pre-COVID, and as a result, you've seen significant reductions in the fleets of existing airlines. And our thesis isn't necessarily we need to go to pre-COVID levels of flying in order for us to be busy. We just need demand to come back faster than the existing airlines can service them. So when I think part of our thesis is at some point people are going to feel they're safe to travel, they're fine to travel. And I can't think of a person who doesn't think of which trip they're going to do next. But unfortunately, there's about 12 to 1,500 planes that are out of the system right now. And so, again, we don't need the travel traffic to come back to where it was before. What the ACMI charter operators tend to do, and we will do, is we kind of fill in the gaps left behind. I think you're going to see the major airlines really focus on their hub cities first and build that back up. We really try to target secondary markets through charters. We look at sports teams. University sports teams is a big part. If you're a casino operator and you have casinos outside of Las Vegas, many operators have in secondary markets. There's just not enough direct flights going between point A and B. One of the things we can offer is with our cost structure, we can offer prices that are competitive with what was scheduled, but also the convenience. We can offer direct flights when they want to have them, how they want to have them. They can kind of control the experience for their customers on the plane. They can check them in the hotel, put them on a bus, put them right on the plane. It's a kind of a different experience. In addition, we're talking to a lot of some of the more national airlines out of South America, and where they didn't necessarily rest their planes, they had their planes taken away. And so there are certain places in the world that need lift. They need planes to be flying there to feed them, to feed the hotels and the tourism industry. and we're basically working with those groups to kind of fill that hole for them.
Okay. And then when you look at, one of your thesis or parts of the thesis is that, your cost structure is going to be lower. Can you just highlight, how durable that cost structure advantage might be and sort of what you're doing to try to proactively insulate yourself against the recovery in the passenger market that might push up, aircraft prices?
Yeah, so you remember our original thesis was we saw a downturn coming in lease rates to begin with pre-COVID, and I think that was, we saw so many new planes being produced, we saw so many planes in the market that the major airlines are really going to focus on new planes first because they need to use them 300 to 400 hours a month, whereas a charter operator uses them a lot less. So we're really about the capital cost of the plane and the supply. That being said, we think this is a pretty unique period in time to lock in rates for a long period. So our goal is to effectively secure either leases or purchase options on at least the first 10 to 15 planes over the next 12 months. And I think we can operate those planes for the next 8 to 9 years. And that cost structure will be in place for that period of time.
Yeah, and I think one of the, on the crewing side too, aren't you trying to, have ownership type of attitudes with your, with your personnel, and so that you are pushing either options or equity ownership into the, into the workforce?
Yeah. So when you think about one of the strengths we have is because of the current environment, we've been able to attract some fantastic people we never would have been able to get, but we also want to keep them. And so one of the ways we've done that is we have issued shares to all the initial class of pilots, and pretty much everyone here is a shareholder at this time. We understand that I think the crew market will eventually recover and it will become tight again. So we have to create an environment where we can attract people. So while we have, I think we posted we have about 1,100 resumes, I think, that we're going through for our first class. We're at, I think we're being very cognizant of what you would have to be like pre-COVID and to attract and retain people and not take advantage of a situation. The advantage we have is we get fantastic experienced people, and that makes all the difference in the world, especially when you're starting up.
Yep, and one thing that in your recent presentations that you and Ed have mentioned is, can you give us an update on the status of the spinoff of the Canadian operation? Yeah,
so our goal is to effectively launch Canada Jetlines up in Canada. When we were formed through a merger with Canada Jetlines, which had attempted to launch a ULCC up in Canada, but never quite got there. We've brought on a president of Canada Jetlines. We've made the application to the transport. Our plan is really to initially start as a tour operator, where we will basically establish the brand, establish distribution, and sell tickets, and have Global Crossing actually fly the flights, which doesn't require an AOC in Canada. It can be done under a Part 380. The advantage of that is you can start figuring out your distribution, your selling profile, figure out what routes work, and in the meantime, apply for your AOC, which is your Air Operating Certificate in Canada. When we merged with Jetlines, their manuals are effectively about 70% done. So that the ultimate target date for that is to launch in December. And basically that would allow not only to be flying from Canada to the US, it allows to fly from Canada to the Caribbean and a lot of the sun destinations, which we think there will be considerable demand for. And so our plan for that is, since a US company can't own a Canadian certificate, is to spin off that company. So existing Jetline, our Global Crossing shareholders will get a share in that, and launch, kind of follow the same model in Canada initially. So it's kind of, I think there's a lot of synergies between the two. It allows to probably, we expect to be able to get certified there for a fraction of what it would take for someone to do independently. And also gives us another outlet for the planes. It's a different flight profile eventually up in Canada. But I think the opportunity to deploy planes and create demand up in Canada and kind of create two airlines for one is a kind of a unique opportunity.
Yep, I guess to be a little more fine on, or a little more detailed on that, so when would you expect the spinoff to occur?
Soon, probably within the next 2 quarters.
Okay, great. And then, Ryan, when you you have plans to essentially establish a headquarter maintenance hangar, and can you update us on those plans?
Yeah, so as all good airlines, they need a home, and so we are talking to both Miami Airport and Fort Lauderdale Airport about potentially setting up a hangar complex, which would have flight simulators and office space. We're going to base it down here in South Florida. We have a secondary base up in Atlantic City. For us, Atlantic City makes a ton of sense. A lot of the last-minute charters, which is a pretty lucrative part of the business model, resonate out of the Northeast, and to be able to have a base up in Atlantic City, which tends to avoid the major weather problems that happen up there, is relatively close to major population centers, and is incredibly inexpensive to operate out of. The goal is to have a hangar facility built up there as well.
Yeah, and I think you're trying to do it with a minimal amount of capital, but what would be the cost of establishing a, headquarters with a hangar and maintenance area? Can you just update that number?
Yeah, that's when we look at that, we've got a number of investors who are looking, who kind of specialize in that, in that space. It's probably in the $20 to $25 million range. Depends how big we want to make it and how the final plans are approved. I think the facility in Atlantic City would be a fraction of that, simply because it's not going to be as robust. Yeah.
And then, your plans to, you have uplifted to the OTC. Can you highlight if you've seen any changes, any would have been the benefits so far, or is it just too early?
No, I think we have. I think we've seen our, we were on the pink sheets, which is kind of limited, and I think our volume was anemic on that level. I think we've seen our volume pick up considerably. I think our average daily volume in this last week has been significant. I think we've seen a real uptick in our price recently. I think that's kind of driven by people starting to believe we're going to do this. I think it's always been a case of, at some point, the market's going to recognize this is happening and what the size of the opportunity is. I think the OTC has facilitated getting more U.S. investor interest, a much broader investor base. And I think we've seen the average volume has tripled, I think, on the OTC, and continues to grow. And I think that's helped rise. We've seen a big increase in volume in the last week and a half or so on the Canadian market as well. And I don't think it's an accident that happened. That those two, I think, are related.
Yep. And then when you look at, your ramp up, and you've been raising capital as you go, sort of on a just-in-time basis, since the uplifting, has anything changed as far as your just-in-time financing strategy? And then once you're up and running, what kind of working capital would you be comfortable with? Essentially money in the bank, or just a targeted range? Is there a number per plane, or more of an absolute number?
So we announced the financing on Friday, and we expect to close that this week. It's effectively full. We've had commitments for a vast majority of it. The one constraint is we want to limit the amount of, we need to maximize the amount of U.S. investors. As a U.S. company, we have to maintain the ratio of 51% U.S. ownership. And so we expect to close that by the end of the week. We believe that gets us the funding through certification and the launch of operations. And when you talk about needs beyond that, I think it would be purely growth capital. It would be tied to how many planes do we want and how fast do we want to bring them on. And so I think we're still evaluating what amount and when we will do something, but it'll be tied to revenue, profit, and growth.
And how much money is left to be spent to, get certified then, Ryan?
We figure it's probably around $2 million is probably what's left to get certified. We're raising between 4 and 5 through this financing, which gets us well there and well into operations. And again, that number is a fraction of what we estimated it would be when we started this in January.
Yep. And then thinking about capital and startup, you said the certification in Canada would be, roughly half, or, even lower than that. Would that capital be raised at the, Canadian, the spin-off level, or would it be raised, that would be raised in Canada?
Yeah, so the idea is to do a direct listing. Into that, we would raise money directly in Canada, and we've already had those conversations. We've had a lot of interest, and that'll be effectively a separate entity, and we'll probably raise the majority of that there.
Okay. And just to highlight or reiterate, you don't anticipate raising any capital to build the headquarters in the hangar?
That if we do it, it would be debt and maybe a sale leaseback kind of idea. So that's not necessarily the core business of what we do. Our core business is flying planes. We think there's an excellent economic model, and there's investor groups that are very interested in it. But that wouldn't be an equity situation, something we'd do equity for.
Okay. And has anything else come up as far as discussions with investors that we haven't covered, Ryan? Anything you want to highlight before we wrap up?
No, I think the one thing we didn't cover very, very, very deeply was sort of the cargo market. And so, we do have an LOI with Bel Air to deliver 10 A321s. I think if you look at some of the other cargo operators and the sizes of their fleets, and if you compare that to what a 10 fleet organization looks like, some of the other ones out there, their valuations are in the B's, and we're sitting around 30 million. So I would never proclaim to be worth $1 billion at our current structure, but I'm pretty adamant it's worth more than what we're at today.
And with the profit contribution, that 150 a month, I mean, is that similar, whether it's cargo or whether it's charter and tour? I mean, it's
kind of a blended rate. It's about the same. Yeah.
And does that scale up with additional hours, or is that, because that was based on 150 hours per month?
Yeah. So, as we get busier and we're able to fill in the schedule, ideally we can get into the 250 hour utilization range, and that will just make that number bigger effectively. So we can either use newer planes, but it would in effect increase that number. Yeah.
And when you talked about the transition of older planes, and is that more acute in the cargo market, where you've seen a lot of older capacity and that needs to be either upgraded or replaced, or there's more efficient cargo? My understanding is the Airbus might be more efficient than other modes. Yeah,
if you look at the Airbus A321, there's one active right now. I think maybe the second one's about to come off the line. When you look at the way it's structured, when you compare it to a 737, for example, it can take 55% more cargo capacity at similar operating cost. And it's a byproduct of the way the plane's built. A 321 can take 14 containers in the top and 10 half containers in the belly, whereas 737 can only take 11 containers in the top and bulk in the belly, which we think is a big differentiator. And so as you look at the 757 fleet, of which is about 346 flying in the U.S., their average age is around 30 years. Planes, once they get to 30 years, they tend to get to end of life. So there needs to be a replacement. And we think having a 321 offering is a differentiated offering. We definitely have the interest of some of the key operators who fly these planes, and they're very excited about what we're going to be able to provide to the market.
Yeah. And one of the, I think the advantages, you might have mentioned it before, but the advantage to the ACMI model is that the fuel costs are passed through, so you're not.
Yeah. So, and that's a great point. So when you think about ACMI and the risk profile, and this is one of the reasons we think this is a good entry point into aviation, is, we charge for ACMI, so aircraft crew maintenance and insurance. The landing fees, airport fees, fuel costs, those are all pass-throughs to the customer. So we don't take that risk, and we don't take seat risk. So we don't take the risk of filling the plane because we sell it on a whole plane basis. So where in some scheduled carriers you need significantly more working capital and significantly larger infrastructure because you do fly empty flights. You do fly those planes that don't make those routes that do not make money. Every one of our flights does make money, and that's basically the nature of the model. And so it is traditionally a lower margin, lower risk, but we think we're going to be able to produce great margins just because our capital costs are going to be lower.
Alrighty. Anything else, Ryan, that comes to mind?
No, that's the story.
Okay, we'll wrap it up there, and I appreciate your participation. Thank you, Ryan, and look forward to seeing how the plans develop with the not only FAA but the rolling out of the planes. Thank you so much.
Thank you, Paul.